First of all, thank you so much, sir, for joining us tonight and taking out time to, enlighten us with your experience, with your knowledge. And I'm really excited. I think I've already said it twice or thrice, so sir. I'm really excited for tonight. This is gonna be an amazing, amazing podcast. बहुत कुछ sir से हम लोग सीखेंगे. And sir, without any further ado, of course, you need no introduction. We all are your fans. So without any further ado, sir, बिल्कुल शुरू करते हैं. Before we get into the the masala of it, I would love to know if you can give us a little brief on how did you get into stock markets and how did you reach where you are? Of course, you have done a lot, but in especially in related to stock markets, if you could have some insights from you.
Sure. First of all, thanks for having me. And please call me by my name. Don't address me by sir. I think that I would be happy if you do that. So my journey, I think it started from college when I basically uh, was studying. So I was interested in the markets, but I did not know like how exactly do you make money in the markets. I knew that okay, you have to have some. I mean, there is some logic to it, but I did not know what the logic is, and that fascinated me a lot because it was a very challenging thing for me at the time, something very tough to crack. So so वहां से चालू हुआ था. That is where I really got into it. And so one thing that I did right from the beginning was that I had a systemic approach towards trading. So generally, when we start off, we are more inclined towards trying out many things. So one thing which I did a bit differently was that I used to pick up an approach, right? Some basic rules around it, and try it in the markets. And I used to try it for maybe 6 months, 1 year, and see how that's working out. So that helped me a lot in the initial phase. But having said that, the learning curve was for good 6 7 years, and only after spending that much time in the market, I finally started putting the pieces of the puzzle together, and so then learned a bit about risk management, having a strategy. Then how do you have uncorrelated strategies that you deploy in the market? So it built upon like that over a period of time. And yeah, I think that's how the journey has been uh, over the past decade. One important point that I would like to highlight is key. I see a lot of folks thinking that it's a overnight thing, that you know things happen overnight and all of a sudden you're making money in the markets. That's not true. There is a learning curve for everyone. It's difficult. It's different. But वो learning curve तो a person has to go through. They have to go through at least one cycle, which is let's say 5 years or maybe 7 years cycle, to understand what the markets are all about. So yeah, that's
That's absolutely brilliant, sir. आपने बोला कि मैं आपको सर ना बोलूं, but it's actually not possible for me because I really, really respect you, and like you said, you have had a long journey and you have learned from your experiences. I, honestly speaking, a lot of our audiences tonight would probably know, or regular listeners might know that I'm still very new to trading. So you are, when I host this podcast, you are actually, I consider you my teacher. I am learning from you, and that's why I have to call you sir. I'm sorry for that. But yeah, that apart, sir. I So next thing is, of course, people like me who I probably are the COVID generation of stock market investors or traders. So for us, it's still very raw. We have seen a good bull run post COVID, and we entered in FOMO, and then saw some results as well. But then, for the past few months, there was a decent amount of correction, and that in itself was a lot of learning for us. But I'm sure there's loads more to come. To start off with, maybe some we can discuss around something on that. If you have any views on that for our generation, what we should be looking out for.
uh, Nothing specific in terms of what exactly one should be looking out for, but I generally have a simple template that I uh, suggest people who are beginners in the market, who've spent maybe less than 2 years in the market. So I first point is start small. uh, do not get carried away. So always whatever you start with should be the risk capital. I mean, you should be okay to part off with that money, or at least 50% of it. So keep that in mind and start small, because initial period is all about learning, right? Second thing that I tell people is definitely maintain a trading journal, because it helps a lot. Every trade that you take or every investment that you make, you should put it down. What is the rationale behind it? Uh, what what is the plan of action when you plan to maybe pyramid it, or when you plan to exit, whether in profit or in loss, and reflect back on that every 3 months, that okay, this is what I had planned and this is how I actually executed. So that also provides a lot of learning, and it tells you, maybe after your journal is gone up to 50 trades, 100 trades, it will give you insights about yourself, about your style. And this is something which has been very helpful for me. And as someone who's beginning, I definitely would recommend ki, definitely have a trading journal. And don't be in a rush to add capital. So even if you taste some success in the initial phase, right, keep it proportional. Let's say if you have made around 50% returns in maybe 1 year, 1.5, 2 years, whatever. So only after that you probably add another 50% onto your capital, right? So for example, you started with 1 lakh, you're now up, you've come up to 1.5 lakh. That is when you can probably start adding to your capital, maybe 50% of your initial capital. So now the capital becomes 2 lakh. Now again, when you are at 2 lakh, you again make 50% on that, so it comes to 3 lakh, and then you can add another 1 lakh. So that ways, the scale up happens in a still in a smooth manner. What I've seen a lot of people do is they get carried away. So after the initial success, maybe they've made a good amount of money, 50, 60, 70% in a short period of time, and then they take upon or trade with capital which is maybe 4 times, 5 times uh, of their initial thing. And that is when they get into that pressure zone, because they've never seen those kind of drawdowns. They've never seen the kind of challenges one faces if the markets are volatile, or in a bear market maybe. So always scale up gradually, never go too aggressive, at least in the initial few years, is what I would say. And another important point, if you're starting with a capital and it becomes half, maybe you've done some wrong trades or some bad execution, then take a break. This is very important, because the general tendency is to make those losses back, like uh, maybe take a bigger bit and probably make some profits to nullify the losses, which is a very dangerous thing, to be honest. So what I tell beginners is, even, I mean, if you have had a loss of capital, since you're starting small, it's fine. Go back to the drawing board, understand, look at your trading journal, what things have worked, what have not worked, and come back with a fresh plan in the market once you're convinced that okay, you have something solid. Don't try to revenge trade, or make the money back. Think of it as a fee that you've paid. And yeah, and yeah, that's pretty much it. If you repeat this process, follow these points over a period of time, I'm sure any beginner would definitely the learning curve would definitely be shorter. So that's my thought process on this matter.
Awesome, awesome, sir. Thank you so much for sharing that. So, okay. So my next questions comes to for us. There are two aspects. One is investing, and one is trading. So, and there is a lot of maybe debate around it, or there's also there's one end of spectrum where there's coffee can investing, that you just put in some money in whatever you believe in, then and forget. And then there is very active trading. I think a lot of people who are attracted to the stock markets come today there because they see people making. There are a lot of P&Ls shared on Twitter as well. And for that quick money mindset attracts a lot of people. At the same time, it's tough. So, do you have a viewpoint on that, on investing versus trading for beginners and for in general stock market as well?
Uh, yeah. So I think it is very, very individual based. Uh, Investing is something that I believe almost everyone should try directly if they have that skill set or knowledge, know-how, or indirectly through funds, mutual funds, and all, or maybe probably through ETFs. Investment though is I believe sub everyone should try and do that. Now, when it comes to trading, it is specific in terms of what your skill sets are, because it's more demanding compared to investing. Is what I believe. The amount of stress, the amount of the amount of bandwidth that it requires, the amount of screen time it might require, whether you're doing intraday swing or a slightly higher time frame, but still it's more demanding. So everyone should first analyze, anyone who wants to get into trading should analyze whether they have that bandwidth or not. And then probably it's something that they have to try it out with a small capital and see if it is if it works out for them. I personally do both investing and trading. I'm a very passive investor, and a very active trader. So that is the combination which works for me. I do not want to tinker with my investments a lot, but trading may I do like intraday or very short time frame as well. So these are two, I mean, very separate things, and but this is how it suits me. If I were to do some sort of a active investing, maybe I might find it a bit tricky or difficult. So is sabka everyone has their own you know uh, personalized way of doing things, but again, this is something that an individual has to discover for themselves. Same process that I discussed earlier: start small and see if it is working for you, and if it is something that excites you, put in more time, more effort. Both are doable, both are good. The good thing is, if you are able to trade as well, the good thing there is that uh, uh, see, you get margins on your holdings. So whatever investments you've made, you can pledge them and you get some margin from that, which is interest free. So the same capital can be used for generating some trading returns. So that's a value add which a trader gets compared to a standalone investor.
Right. Right. Absolutely perfect, sir. Sir, you said that you are a passive investor and a very active trader. Can we have a little bit of inside scoop on what you look at before investing, one, and second, while trading, your strategies, some inside scoop on your investment philosophy. What do you look at and how do you do that?
From an investment point of view, I am I do not have too much knowledge when it comes to fundamentals. What I try to look at is whenever there is a panic in the market, when there is a sell-off, when there is fear in the market, that is the time you get in. And at that time, I do a sector analysis, basically looking at how are the different sectors performing, what is the relative strength for each of those sectors, and if there is a sector or maybe whatever are the top 3 4 sectors, then I look at what are the relative strength of the companies in that sector. So then I invest in those companies and I manage uh, in a way ki, there has to be a certain percentage of large cap, mid cap, and small cap. So maybe like 40 30 30, and yeah, then I I mean, if it goes down further, is more fear, then I'll again do the same thing and add on to the existing holdings, or maybe add a few more. And when there is a lot of, maybe the index is making all time high or something of that sort, then I'll start selling. I'll keep selling on every rise. So that is very systematic. I have a strategy in place which I used to do this. And yeah, like for example, in uh, in the recent sell off, it was very visible that the auto sector was outperforming. So and within the auto sector, it was very easy to see which are the top few companies which are, markets. If markets fell by, let's say, 5%, those companies, some were not even falling, some were falling by hardly 2-3%, right? So, and but when the market started to rise, these were the leaders. So I mean, that is how you kind of get into uh, the investments into these companies without having much knowledge of fundamental analysis. So that is the approach that I have when it comes to investing. And when it comes to trading, it's it's all over the place. Uh, so I do both systematic and discretionary trading. There are a few systems which I deploy on mostly on options, some on futures, and there is a discretionary element to it as well, which I've developed over the past few years. That okay, maybe the premiums are too high, too low, and looking at the volatility, look at multiple parameters, and then take a call. Okay, this. So basically, you form a view first. And then according to the view, the second piece is you set up a position with a proper risk management framework, that okay, if the view goes right, this is how the position will perform. Maybe it will give me, I'm risking, let's say, a capital R. If the view goes wrong, I'll lose is R, but if my view goes right, I might end up making 4R, 5R. So you always try and get into a position where your reward to risk ratio is really good. And then the third piece is how you manage that position. If the view fails, you exit with whatever loss it gives you. Uh, yeah. So that is how the trading bit happens, and this is across time frames. This could be intraday trade, or a monthly trade, or a quarterly trade. I
Right.
hope this makes sense.
Yes, yes, absolutely, sir. So, I think a very critical aspect of what you said in both investing, even you said key panic selling is important, and then in trading also, it's a lot of it is discipline, a large part of it. I think psychology plays a lot of role in it, where when there is panic, at least for new investors like me, it's very difficult to hold on and not give in into the panic. And during discipline also कि नहीं अब तो ये नहीं बचेगा, this has gone wrong and what do I do, और अगर वो जरा सा भी profit आया, even if it's in the 5-10% profit आया, it feels like कि नहीं बस enough हो गया, let's book it. uh, so how can you give us a little insights, a few insights on how to balance that out, maybe the psychological aspect of it?
Sure. So what you said is this happens with everyone. It happens with me as well. And this is a challenge that as a trader investor, we have to somehow overcome. So there are two ways which have helped me overcome this to a certain extent. First is backtesting. So if you backtest, you look at historically, if you would have settled for maybe 5-10% versus maybe if you go on and trail it to get maybe higher, like 20-30%, then there is a stark difference in the results, right? So that gives you confidence that you should always aim for a higher reward compared to the risk you are taking. So if you're taking a risk of R, then you should at least get 2R, 3R, 4R kinds, right? So historically, if you backtest any strategy, I mean most of the strategies, this will be the case, where you should always be patient with your winning trades, and you should be very impatient when it comes to a losing trade. You should try and cut them off right? I mean, as soon as your view fails. But if it works out in your favor, then it's better to probably trail it or book it partially rather than just getting out uh, very quickly when you get small returns out of it. This also happens because we look at, this psychology of booking profits very quickly also happens because we are fixated on one single trade, right? If you look at a group of trades, that is where the backtesting piece helps. If you look at a group of trades, there will be cases where a stock is gone up and given you 10% profit, and by the time you book it, it gives you only 2-3% of profit, right? But there will also be cases where it has gone up 10%, you don't book it, you trail it, and it goes in your favor by another 20-30%. So so backtest your strategy. That will give you a lot of confidence. At least that has worked well for me in terms of I can see it in the results. Maybe one or two trades, it'll hit my trailing stop loss. But in the long run, when I look at the aggregate of 100 trades, then this is the right thing to do. To wait and look for higher rewards. And the second piece, if you look at all the big investors or traders, if you look at what they've said in the past in the interviews, or maybe if they've written some books, Market Wizard is one excellent book where you get to get into the mindset. You get to know the mindset of all the big traders and investors. So one theme is common in that, which is cut your losses and let your winners run. This is very common across all the big shots. So that also helps you change your psychology, that you know most of the people who've done well in this business have this one thing in common. So yeah, these 2 points: first, back test it. That gives you confidence from a data perspective. And second, look at what the biggies have done, how they've made money. There also this theme plays out really well. So that gives me at least a lot of confidence in holding on to winners.
Right. Perfect, sir. My next question is regarding trading itself. There's a camp of systematic investing, and then there's a camp of discretionary investing. So we already got some insight on how you trade, but could you delve a little deeper into it and throw some light on these two aspects? Your thoughts on it?
Absolutely. So first, let me briefly, in a couple of sentences, try to describe what are these two and how they're different. So systematic trading approach basically means that every decision that we take in a trade is predetermined. When you have to enter, what is the quantity, what should be the stop loss, what should be the exit in case your target is hit, right? So everything, you do not make any decision during the trade. All you have to do is execute as per the predefined levels or predefined rules. So that's systematic trading. The second piece is discretionary trading, wherein things are a bit uh, the decision making is, it happens actively. You are constantly looking at a lot of variables, and then you decide to enter. Then you slowly decide to build your position, and it's not defined that this is the point where you're going to book profits or take the stop loss. You constantly look at all the variables. Maybe you're looking at price action, open interest, you're looking at the news flows, and then making a decision on the go. So this is the basic difference between systematic trading and discretionary trading. Now, I believe that from a beginner's perspective, systematic trading is something which is easier, right? Because it does not involve making decisions on the go. What I've experienced with myself, at least, and I've seen it with many traders actually, that whenever you take a position and you see red in your M2M, your decision making capabilities are not do not remain as sharp. There's a good possibility that you might take bad decisions when you see a big red MTM or a big green MTM. So that is where I feel, as a beginner, till you have complete hold on your emotions, it's better to be a systematic trader. And once you have seen the screen, or you have a grasp of how the markets work, probably 3 years, 4 years down the line, one should uh, try and see if discretionary approach works for them as well. But starting off as a discretionary trader, in my opinion, is very, very tough. So yeah, so that's how I would like to put it. Yep.
Right. So that's perfect. थोड़ा सा और इसमें to delve a little deeper on the risk management side of it, because I believe a lot of discussion that we have done so far is regarding systematic versus discretionary trading, or earlier what should a beginner do and how should they deal with it, and we got some great insights from you. Start small and take a break instead of trying to revenge trade. Uh, Cut your losses and let winners run. So a lot of it has revolved around risk management. So can we discuss it as a standalone topic? What are your maybe top three or some best strategies that you've got that you do to manage your risk? Do you have uh, the beyond stop losses as well? How do you deal with them?
Sure. So if I have to put it in a few points, so the first point would be, uh, like, never risk more than a certain percentage, maybe let's say 2% of your capital in a particular trade. Right. So this will save the portfolio from going bust. Right. Uh, so that's I think the most important one. You fix up a percentage, maybe it's 1%, maybe 2%. If you're very aggressive, it could be 3% per trade. But one should never risk more than 2% to 3% of their capital in a single trade. Now, why do I say this? Because imagine, like, you're running a system, or maybe you're a discretionary trader, things are not going well. You can very easily get 10 losing trades in a row. It will happen over a period of time, because if you look at the probability, the 50%, generally we have a 50% probability of winning or losing, right? Because no one knows how things are going to go. So, with a 50% probability, the losing streak can easily go up to 8 trades, even 10 trades, like continuous trades, 8 to 10 continuous trades, which are loss making. So then you have to think, like, what is the maximum drawdown that you are okay with. So if you're okay with let's say a 20% drawdown on your capital, and you're looking at 10 losing trades in a row, then should probably stick to 2% risk per trade, should not exceed that, right? uh, this is the first point. Have a fixed risk per trade. Second is, every trade should have a similar RPT, or I mean, every trade in a system. So there might be multiple systems a person is running, or multiple approaches towards trading that they have, but within a certain approach or within a certain system, the risk per trade should be standard across all the trades, because we do not know which trade is going to work and which is not going to work. So it should not be that, let's say I have a ORB system, opening range breakout system, and one day I'm taking a risk per trade of 2%, the other day I'm taking a risk per trade of 5%. So that is a big no-no. So for a certain approach, a certain system, have a exact same risk per trade for all the trades. This is the second point. The third point would be, the overall, at any given point in time, you should not have more than maybe 10%, uh, a possibility of 10% risk. So if you're taking RPT of 2%, a maximum of 5 trades should be open at a given point in time. So with these three things done, I think uh, these are good enough to safeguard your capital, even if uh, you are a beginner, or even if you are at a advanced stage and you're scaling up. So this should uh, you know help you with the risk management bit.
Right. Perfect, sir. Thank you so much for sharing that with us, sir. Okay. So, sir, I had pinned a tweet in this space on the top of this space, asking people to ask their questions in the comments of that thread, and I'm getting a lot of questions. So, can we take up a few questions from those comments, sir?
Yeah, sure.
Okay, okay. So, पहला question, okay, Harish Kumar Narayan Pillai sir का है, and he has asked it in two parts. There are so many data that we look before entering any trade, but before entering into trade, which parameter is the most important to you? So, what type of data are you looking at, and from what sources? Maybe if you can share.
Okay, Harish. So I generally, so from a, like, let's say if I have to create a system, right, then I would try to look at as limited amount of data as possible. Because mixing too many things, it becomes very difficult to make sense of it, right? So for example, if I have a system which is based on price action, so I would want to stick to that. A simple Dow theory which has been working for, decades now. So that's a good starting point. Start with price action, learn Dow theory, how it works, see how that fits into the present scenario. How to understand a trend, uh, and once you master one data point, only then go on to something additional is what I believe in, because the more we add on to a chart, right, or the more data points we look at, it complicates the entire thing. Maybe it is beneficial to look at a few more things, but for the sake of simplicity, it's always good to start with something very basic, get that sorted, understand it end to end, master it, and then probably pick up one more data point. So the first data point that I would recommend is looking at price action. Once you are done with that, it will take a lot of months or maybe few years to get a grasp on that. Then probably the second piece could be, basis your interest, it could be you might want to look at OI, change in OI, or uh, I don't know, I mean, maybe look at some fundamental parameters and club that with price action. So the second is will depend on your, you know uh, your affinity towards, I mean, how you get attracted to certain things. But the first point would definitely, if someone asks me, would be to learn price action.
Right. Perfect, sir. Thank you so much for answering that, sir. Okay. Next question. दो questions हैं. Amit Sharma sir का question was, sir, is it right to average any stock when it went down? And GJ sir ka question was, any thoughts about Zomato falling? Will it recover? I think both of these questions are related to a very popular debate that goes around these days, which is buy the dip versus stay with the stock that did not fall when the market fell. So stay that showed strength even when the market fell. So which do you which camp do you prefer, sir? Do you believe in buying the dip, or do you believe in the stocks that do not fall when the market falls?
I believe in the second one, the relative, wherever you get better strength. So when the market is dipping, when there is fear, as we discussed earlier, that is when you look at the relative strength and probably go with something which is outperforming. First, you look at the sector that is outperforming the index, and then within that sector, you look at a few companies. But even like if you talk about something which is going down really hard, like Zomato or Idea for that matter, so these are very risky trades. So here it's not like you cannot trade, but you should have a view as to what you are getting into. If you're bullish, then what is the reason for that? Uh, and you build your positions accordingly. If it's a FNO stock, then you have more options to play around and build your position, and then also have an exit strategy if things do not work out. See, the thing that happens with these kind of stocks is that when they zoom very, very fast. So it's the same pace. They'll fall like 50% in a couple of months, and then they might also from the bottom move 50 to 100% in 2 to 3 months, and that is where a lot of people get attracted. But and there's nothing wrong with it. I mean, if you can play that out in the right manner with the right risk management in place, that's a fabulous strategy to sort of deploy. But you should probably think about one should definitely have a plan around it कि how you're going to handle that. केवल फैसिनेट होके नहीं लेना है उसको, उसमें थोड़ा सा सोचना पड़ेगा कि at what point you need to get out, or maybe average is a definite no-no in such kind of stocks, in my opinion.
Right. That leads me to our next good question. This is by a handle called Woo. So, sir, unka question is, if we book profit, the market goes up more, leaving us into regret mode. And if we don't book profit, it does a U-turn. When to exit in an optimal manner is my question. So, I think that is a very important question about the exit strategy. A lot of people, including me, who are into stock markets, new into stock markets, they know how. मतलब, tips are available all over. थोड़ा सा छोटा मोटा टेक्निकल सीख लिया, थोड़ा छोटा मोटा स्क्रीन में देखना सीख लिया. So entry points we are able to understand, but exit is something that is very tricky, I believe, and you also kind of touched upon the same thing ki, you should know when to get out. So what is an optimal exit strategy according to you, sir?
So there can be two approaches to this. First one is if you are running a strategy, so you can easily backtest. If the rules are defined, you can backtest and see the results and arrive at any area where generally it gives you good profits. Maybe some strategies probably 2 times of what you are risking, or 3 times of what you are risking, or maybe 4 times of what you are risking is a decent. So looking at the data, if you analyze the data, you will get a decent understanding of when to exit. In the discretionary side of the world, it becomes very tricky. So there you have to trail it is what I believe in, because if you look at all the biggies, as I earlier said, one thing is very common and everyone says this: let your winners run and cut down your losses. Be very patient with your profits or winners, and be very impatient with your losers. So that I think, since that is something that is very common in all the people who've made it big in the markets, तो वो approach हम लोग लगा सकते हैं, wherein you come up with a simple trailing strategy whenever you are, let's say, for example, I get into a stock and my stop loss is maybe 10%, and so what I'll do is, once I'm up by 10% or maybe 15%, this can be fixed, then I start trailing it, right? Now, how to trail? It could be a simple moving average that you trail it with, or it could be, let's say, अगर previous day low break हो गया, then I will exit the stock. Or it could be if the trend changes. If you are into price action, so maybe you look at the 15-minute trend or half-hour trend, and you see if there's a lower low formation. That is when you exit. So and you keep this constant. This is not for one trade. So for every trade that you take, this trailing stop loss thing has to be implemented. So what will happen is, in some of the trades, the trailing stop loss will get hit. At one time you were getting maybe 15-17%, and you exit at 10%. Or maybe sometimes you're getting 7-8, maybe 10%, and you exit at flat. But there will also be trades where you're getting 10-12%, and then you probably end up getting 30% or 40%, right? So these are the two approaches. First, backtest if you can. Second, let them run and have a trailing stop loss. अच्छा, trailing में भी some people are not very, they also get confused कि boss trail कैसे करना है. Trail करने के भी बहुत सारे तरीके हैं, right? तो उनके लिए the other thing that they can do is they can book partially. So that is also a good strategy. Let's say your initial risk was 10%. तो आप जब आपका प्रॉफिट 20% हुआ, यू बुक 25% ऑफ द पोजीशन, सो यू आर कंफर्टेबल कि बॉस चलो अब थोड़ा पैसा अंदर आ गया, एंड देन अनदर 5-10% you book another 25%. So that could also be a very good approach. So you're booking it partially as it moves in your favor. And one has to, I mean, the individual has to understand what works for them, because trailing again could psychologically be a bit difficult. But जो profit booking, partial booking वाला है, that is relatively easier, because you're getting some comfort कि हाँ 25% of the position I've kind of booked. So yeah, that's
Right.
these are two approaches that I would probably subscribe to.
राइट सर, इसी का एक कोरोलरी क्वेश्चन जो मेरे दिमाग में है, दैट इज वन इज पार्शियल प्रॉफिट बुकिंग एंड द अदर स्ट्रैटेजी इज पिरामिडिंग मे बी. सो how can we decide whether this is a good time to book a partial profit, or is it so again, this is agar systematic hai, to I think this kind of becomes a little easier, but in discretionary trades, can you give us a little insight on how to decide between pyramiding our capital ki isme aur dalna hai, abhi to ye aur jayega, versus thoda sa partial profit book kar lena?
So let me admit that pyramiding is something that I personally am very bad at. So whenever I think I'll pyramid, I'm not very good at it. So I think there is some psychology behind it, which even I don't probably understand completely. So I generally prefer ki boss, whatever is the position, you build it at once, maybe no, within a few hours. You don't wait for price action to do this and that. But generally, what I've seen is people, the way they pyramid is whenever, using price action, whenever there's a higher high formation, they will add on to their position. So as in when it goes into your favor in a very logical manner, they add. Or maybe they also, whenever there's a higher high formation, and there's a higher low formed, then they probably a correction in the trend, basically that is where they would want to add on to this. But pyramiding is a very which I feel is a very expert level thing. तो उसमें बहुत अभी there are a lot of things that one needs to master before getting into pyramiding. Pyramiding का ये भी है कि when your capital grows and it comes to a certain level where you cannot deploy it in one go, तो वहां पे भी that is when I see a lot of people get into pyramiding. But it is not that trivial is what I believe. But using price action, one can probably have can get a decent approach towards pyramiding.
राइट. एंड सर, इसी का एक थर्ड एस्पेक्ट जो कि बहुत पॉपुलर है आजकल मार्केट्स में, दैट इज एसआईपी. सो डू यू हैव अ व्यू ऑन दैट एज वेल?
My view with the SIPs is it's a very good tool for someone who is not very market savvy, who is not who does not understand the markets, and they want to invest gradually their savings. But I still believe that the SIP should be done in a graded manner. When the fear is more, the SIP quantum should be higher, and you should also do a reverse SIP. When the markets are booming, like they're making all-time highs, then you should also try and gradually take off some money from the table. I mean, if you look at the data, it's very clear when the markets are trading in a percentile where the PE is above 90th percentile, the PE of the index, right? Then over the next 1 year, markets have generally given a negative return, flat to negative return, right? So at that time, there is no point doing SIPs. The sense over there, the common sense over there would be to take out some money, right? So SIP is good, but do it in a graded manner. Know where the markets are. Have some basic. If you have some basic understanding of the markets, तो वो एक आध वेरिएबल्स डाल के भी यू कैन वेरी इजीली डू अ बेटर जॉब ऑफ इट. एंड अगेन be very careful in terms of what instrument you are investing in. So I generally say that go with ETFs because uh, I mean very few mutual funds are actually able to beat the index ETF returns. So unless you're getting a consistent outperformance for a long period of time, it's better to do it ETF SIP.
Right. Awesome. Awesome. Amazing. So thank you so much for that. Okay. Next question is by Samvek sir, and he's asked, "Hi, it is said that you can make big money when you develop a view on how the markets work. Uh, can we know from you, sir, what are the basics you believe one should know to develop views on market?"
Uh, I think looking at the historical events and the historical prices, spending some time to understand how they've moved in the past, that gives us helps us develop certain some basic understanding, and then also very closely watching what is happening in today's day and time, and like uh, looking at what maybe reading or looking at the interviews of the top traders and investors from the past. So all these things, I mean, learning from their experience will also definitely help develop some understanding. And yeah, and I also believe in what you said, that if you are able to form a solid view of what is going to happen, and you apply a basic risk management and put down a position, then there is a big potential of making good money. So but this it requires a lot of conviction, and that conviction will come when you look at a whole lot of data, a whole lot of price action and market behavior, so to say. And but there also, I think what the approach should be that out of the 10 views that you form, maybe you will be right 5 times, but when you're right, you should make at least 5x or 10x uh, the money that you lose when your view is wrong. So that is where uh, it becomes fun. Otherwise, uh, it's I mean, uh, forming a view is like like in my head, it's like taking a big bet. So वहाँ पे the risk would definitely be there, but the return should be very very handsome for you to take that uh, bet.
Right. Perfect, sir. Okay. Next question, sir. Shivam Kumar Sharma sir का है कि on which sector are you bullish? So थोड़ा सा I think we touched upon कि auto sector was something you were looking into a while back, but do you have any sectors on your watch list right now, maybe?
Uh, Not really. Right now, no. So I've shared the approach that I use. So whenever you know there is a dip in the market, you feel the markets are maybe down at least 8 to 10% from the top. That is when you start looking at the sector-wise strength, and yeah, from there you will get to understand which sector is sort of outperforming, and then within that sector you pick a few companies. So auto, as I said, in past few months it's been very resistant in terms of when the index was falling, it was not falling as much, or maybe going up as well. And then when the index started going up, it was the first to sort of go up. And similarly, IT, if you look at when the index was falling, IT was cracking the most, right? So that was underperforming. So it's also important to understand that which sector you might want to avoid. Uh, so that's the approach that I use. Very simple to sort of uh, make a view on like where to do the investments, which sectors to invest in.
Right. Right. Perfect, sir. Okay, Mahesh, sir का question है, sir. Is this okay to have a system with a low RR, but maybe around 0.5 to 0.6, but with a high win rate, higher than maybe 70%?
So 70% win rate and reward to risk of 1 is to 0.5.
0.5 to 0.6, even
That's it's okay, but the edge in such systems is very low. You need to have even higher success rate, right? So maybe if you have a 90% success rate, then this kind of a reward to risk might make sense. And it's okay. It's all right. It's good to have that system, but every trade should have a defined risk. That is the only criteria, right? Otherwise, I mean, selling an OTM option which is 2 sigma out gives you a win probability of 95%, but the risk is not defined. So although the success percentage or the winner percentage will be very high, but the I mean, since the risk is not defined, there could be one or two trades which take away the entire profits. So in these systems, the only thing that we have to sort of make sure is that uh, the risk for each trade is defined and the edge is positive. So a 90% win rate with 0.5 is to 1 reward to risk is a decent system.
right. Right. Perfect, sir. Thank you so much for answering that. Okay, next question, sir. Vaibhav Anand sir ka hai, and he has asked, do you add capital for scaling up? If yes, what is the criteria? Second is, if a trader reaches a certain landmark where the capital is huge, say, let's say 20 crore, would you recommend diversification into real estate? And third is, how do you scale up in discretionary trading?
Okay. So, uh, so for beginners, I touched upon in the initial phase how one should scale up, right? So if you're starting, let's say, with 1 lakh capital and you make 50% profits on that capital, whenever you make it, then you add 50% more into your account. So from 1.5, it goes to 2. Then again, if you make 50%, so you come on to 3 lakhs, then you can add another 1 lakh, maybe 1.5 lakh from there on, and this is how you scale up gradually, right? And this happens really fast if you are consistent and if you are able to do the right things. So it takes care of the scaling part very smoothly, right? And the second question was uh,
So
on
diversification into
diversification.
real estate.
It's a good idea. I think as you know, a person spends more time in the markets, they understand the risks better. They tend to diversify. This is the general norm. What I believe in is that during the initial phase, when you are building capital, you need to be aggressive, and at that point, the diversification uh, might be counterintuitive if you want to really scale up. But at some point, definitely that point is different for everyone. One has to diversify to make sure that you know uh, uh, it's things are stable. The returns might be lesser, but things are much more stable. So real estate is a good option, but real estate, again, the challenge is you've invested so much time learning about the markets, how they work, how the equity works, how the derivatives work. You have built strategies and everything, and then you have to spend that much more time into understanding how the real estate works, because that is also a very complex piece. So if I talk about myself investing in real estate, I would want to, but I am a bit apprehensive because I don't understand how it works, right? वहाँ पे भी there are risks which are unknown to me. In market, still I understand maybe top 95% of the risks. There's still 5% which I don't understand. But real estate, maybe I don't understand 90% of the risks involved. So someone who wants to get into real estate, if they can uh, maybe partner with someone who's very good at it, or spend some time learning like they did in the markets, then it's a good diversification. Gold, I feel is better because there इतना कुछ risk नहीं रहता. The learning is not very steep or not very long basically. So gold is, for me, I prefer gold over real estate when it comes to diversification, and a mix of both digital as well as physical.
राइट राइट परफेक्ट सर. सो सर क्वेश्चंस हम लोगों के पास बहुत 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 सारे आ रहे हैं बट हमारे पास ऑफकोर्स टाइम लिमिटेड है. सो आई हैव अ कपल ऑफ ऐसे क्वेश्चंस जो कि क्विक मे बी अ रैपिड फायर काइंड ऑफ इफ यू अलाउ वी कैन हैव. सो वी गेट टू लर्न अ लॉट मे बी. आर यू रेडी फॉर इट सर?
Yeah, I can give it a try. Sure.
ओके सो पहला क्वेश्चन यही लेते हैं कि अभी वी वर जस्ट डिस्कसिंग रियल एस्टेट एंड गोल्ड एंड अदर diversification. So there are a few instruments I'll probably list out, and maybe we can have your preference around all of them. So the instruments are equity, bonds, mutual funds, gold, real estate, and fixed deposits. Six. So amongst these six, your preference from highest, most preferred to least preferred, maybe.
So least preferred is FD for sure. Most preferred is equity, gold, and bonds.
Okay.
Yeah.
Okay.
And whatever remains is in between.
All right. Mutual funds and real estate somewhere in between. All right. Awesome.
Yes.
Okay. Your favorite ever trader, maybe the person who inspired you the most, or you find them the most talented. Your favorite trader or investor.
I've learned so many things from so many people, and I don't believe in idealizing anyone. So, but I think everyone you talk to has something to offer, and I've learned a lot from Twitter, from talking to traders in person. So, yeah.
Awesome answer, sir. Okay. Your favorite book related to stock markets.
I really rarely read books as such, but The Market Wizard is one book that I really like. Once in a while, I go through a few interviews, so a lot of learning that comes from that.
Awesome. Okay, so one stock that is your favorite, that is very close to your heart. It can be any number of reasons that you understand its behavior the most, maybe, or it has given you the most returns, or it was your first stock ever, or any reason. One stock that is closer to your heart.
Uh, it keeps on changing, yeah, every second week, third week. So there's no fixed stock as such. Whatever
Okay.
is volatile is at the time is what I prefer trading in.
Okay. Same thing for sectors, maybe. Any favorite sector that you maybe track more than the others?
Same thing, whichever sector is moving. I think generally steel as a sector moves a lot. So that I think you generally get a lot of opportunities in steel, sugar, a lot of volatility. So these two sectors, it's always more often on the radar compared to other sectors.
Yeah, awesome. Awesome. Okay, your favorite indicator.
I mostly look at price action. So everything, I mean, most of the indicators are derived from price action. So the only indicator that I really, I mean, sometimes use is a moving average. So price action, I would say, is my go-to thing when I open a chart.
Right. Awesome. Awesome, sir. Okay. Next is probably one mistake that you did in along your journey that you still regret, or it can be a missed opportunity that you saw but didn't take, or something that you learned a lot from in the stock market in your journey.
Mistake would be not following the rules. At times, I've uh, taken bigger bets compared to what I should have. So the thing that we discussed earlier, right, having a fixed risk per trade. So breaching that is a mistake that I tend to do at times. So that is probably the biggest thing that I need to improve.
Awesome. Okay. One thing you're probably it can be your best trade or something that you really caught on time, or it can be the your multi bagger that you really an opportunity that you identified the best. That's something you're kind of proud of.
Um, so the best trade is yet to come, is what I believe. It's still not printed for me. But of all the trades that I think one recent trade was really good, where I was bullish on Bank Nifty in the last series. So wherein I got into 35,500 call on the monthly, which was like really out of the money. But that worked out really well. A bit of luck, a bit of analysis, and that I think is uh, that's a good trade. But I think that's not the best. The best is yet to come.
Awesome, awesome, sir. Okay, growth investing or value investing?
I would go with value investing.
Okay, awesome. So these were some of the questions I had, sir. But before we part, can I have some maybe a concluding remark or an advice for the people here tonight? Something to put all this awesome session together.
I think we discussed a lot of things which are very relevant for from a beginner's point of view, and I would like to thank you guys and everyone who's been here patiently. I remember when I started off, we did not have these kind of sessions or learnings available, and this really helps reduce the learning curve. So thank you to you guys for having me, and to the audience for being there. The only thing that I would probably want to share is that think of investing in trading as a wealth creation journey. Don't think of it as some income generation tool. And it's more of a marathon than a sprint. So give it time. You will go through multiple drawdowns, multiple setbacks, failures, but stick to it. In the long run, it has the potential to be very, very rewarding. So be patient, don't give up, and yeah, that's it. And 10 years down the line, you'll not regret it.
Right. Thank you so much once again, Manu sir, for your time, for all the brilliant gems and insights and experiences that you shared. This was amazing. Thank you, audience, for being there with us. We have over 750 people even now listening to us. And I know there were a lot of questions. I'm sorry we couldn't cover all of them, but I think a lot of questions that you have posted, we did cover them in the podcast. We'll release a recording of this podcast immediately after it. So please go through it if you joined late. I'm sure a lot of questions would be answered if you listen to it. Once again, thank you everybody for your patience. Thank you so much, Manu sir, for coming with us. And everybody have a really good night and a really profitable day tomorrow. Thank you so much. Bye bye.
Thank you. Bye.